This is Stephen Ware. I'm joined by my business partner, Fernando Angelucci. We're out here in lovely Las Vegas for the ISS World Expo. Fernando is back from his sabbatical in Brazil. How are you feeling being on American soil?
Good. I'm feeling a little weathered after these 3 days of ISS, but feeling good. Good to be back.
Self-storage brings us so much bountiful joy that when we all get together, us storage guys tend to get a little rough and rowdy, huh? So, since you've been here, you've been making the circuits through the various seminars. The way that the World Expo is laid out, they have their various tracks.
Right.
Did you find yourself doing one track more than others?
I spend most of my time on the investing track. So the two that I would like to highlight today was Brett Hatcher, who's from the Markets and Millichap Hatcher Co. Group, and then Mike Mealy from the Mealy Group. So both are brokers. They were giving updates on the state of the market. So I found some very interesting things in these presentations. So first of all, Brett did a great job. He usually only has 30 minutes to do this presentation, so he had an hour on this one, so he went off on some very interesting tangents.
Wow.
Key points that I pulled out was, I've been talking to a lot of lenders recently, and they're questioning our lease-up schedules and the rent raises, and they think that the world's falling apart because it's falling apart for other industries, but it's not really for ours. So interesting points that I pulled out was, first, rents are up 1.5% year over year.
Surprising.
Exactly. So a lot of people have been underwriting, as interest rates have increased, people have been underwriting rent decreases, and that's not what we're seeing. He also pointed out something specific to one of our markets, which is in Florida. We currently have 5 ground-up developments under contract. We have another 6 in pre-contract negotiations at the moment. And he said that this, first of all, he always prefaced the supply index is basically a bogus number, and we can't really rely on it. It's more about competitor demand. But if you're going to throw a supply index on the Florida markets, you should be seeing stabilization at 10 to 12 square feet per person. So
he gave an actual supply index during his presentation. That's a bold move.
I know. So, it's because he spent so much time down there, and he's got a lot of projects down there.
Is that where he's based out of?
No, he's based out of Ohio, but his family is a development family. So not only does he see the broker side of things, but he sees it from an owner-operator side. He also invested in a bunch of syndicators' deals.
Okay.
So based on where he was going, he mentioned the Tampa-Orlando corridor, which is where we're doing a lot of work. He said that to be safe, 10 is roughly where equilibrium is in those markets just because of the massive population growth. But he would do deals all the way up to a 12, but they would have to be like slam dunk deals for him to do it in a 12 supply.
So for context, the self-storage almanac that gets released every single year, that's put together by, I think, Newmark, Knight Frank, and Minico Messenger, if I'm not mistaken. They came out with 2022's supply index number, the supply of net rentable square footage per capita across the United States as well on state level. But in the national supply index figure, it's at 6.1 for 2022. So it's very interesting that on the state-specific side, a industry expert like Brett Hatcher is saying, supply index be damned, double that.
Yeah, I mean, we've seen it in our own underwriting. We go look at deals where the supply may be 7, 8, 9, but all the competitors are full, above 90%, and the rents are going up. So,
well, we often talk about how supply index numbers are an upstream metric, so getting the downstream metric of what the supply index number is supposed to be predicting, the actual landscape of occupancy. If we can see that all the competitors are occupied, usually a good sign, but it does tuck us in at night and make us feel pretty warm and fuzzy if we get a below national average supply index number.
So I asked him to send me this presentation because I've been getting a lot of kickback from lenders that don't really know the space, and I'm just going to send his presentation unadulterated and be like, here's an industry expert. He closed 2-point-something billion last year. He's going to close like 1-point-something billion. He's projecting that his entire team, including Gabe, Nate, and the rest of the juniors, they're going to be about 25% down as far as sales goes. And that led into his next point, which was talking about the financing environment. So obviously right now, deals that are getting done are cash deals because they don't have to worry about debt service requirements. They can close fast. And they said of the deals that are financed that are closing, the ones that win out are the ones that have 30-day due diligence or less and have a 15-day close or less after that 30 days. He said that's the worst that he's seen people be willing to accept. So I was like, well, interesting. That's not what we do, but
That may be a little biased, though, don't you think?
Yeah.
I mean, as a broker, he's looking for the volume, keep it moving. So if he can tell
Right.
a crowd of 1,000 people that we should all be having 45-day closing timelines, that would be pretty nice. I mean, I would love that, but I mean, the banks aren't moving that quick, so that's a cash kind of structure.
well, so and what he was talking about is you just basically bringing the bank in earlier, so you're getting all the pieces moving before you even go under contract, so that once you go under contract, the bank is basically ready to close. And it's like
That sounds pretty rose-colored glasses to
right,
me,
but that's what he's seeing. Another interesting thing is he was using a lot of Marcus & Millichap has a research group arm.
Yeah.
That all they do is research. That's all they're employed to do. So he was using a lot of their statistics and their graphs. One of the interesting things is cap rates have risen. Now the average cap rate in the United States is, what would you guess?
I'm going to say 5.3.
It's 5.5% cap rate. You're very close.
Pretty
That's
close,
That's
huh?
good. A lot of people freaking out thinking they're going to be buying deals at 8 caps and 9 caps now. It's just not the case. People are still closing. They're just dropping leverage.
I just wish there was a way for that to be tranched, like across
Class A, Class
markets.
B,
I mean, I think
Tertiary.
markets would probably be easier just because the whole Class A, Class B, Class C stuff is kind of subjective to opinions. But
Right.
at least like if they could pair it up with a population cross data, I mean that'd be fascinating. Because I mean these big guys, I mean they're still going to be buying the giant facilities at these super low cap rates because it's all about first man on the moon.
And he also talked about how the large REITs have just finished huge rounds of fundraising. So they're sitting on a ton of equity. SROA, he called out specifically a couple of the publicly traded REITs. He was talking about how they just finished up funding massive rounds. And they're sitting on cash and they're trying to get things done. I mean, we've already, just talking to people in the hallways, there's a lot of people that are still getting unsolicited offers on CO deals. Now, if those pencil or not, I'm not sure, which I'll cover here in a second when we go to Mike Mealy's presentation.
Did he mention with these REITs that are sitting on a king's ransom of equity that they've raised, are they pursuing more developments themselves, or are they just specifically searching out those CO deals, those certificate of occupancy?
So from what I've seen, he didn't really touch on that, but from what I've seen, the large publicly traded companies don't want to take on development risk. So if the asset's out of the ground, they're willing to take up the lease-up risk, where in the past they were not willing to do that. You had to come to them at the real aggressive ones were 40% to 65% occupancy. Some of them will wait till 80, 90 because they want them stabilized. But now they're trying to reach they just don't have inventory, and they're sitting on all this cash that's burning a hole in their pocket. Interesting point that he brought up, which I thought was just like fantastic to highlight. Over the last 10 years, on average across the United States, self-storage has appreciated 133%.
Past 10 years.
In 10 years.
So about a 13% annual appreciation.
Yeah. So, I mean, that's fantastic. And that's the average. So that's including, your Class C, Class D assets that are in the middle of nowhere. And then obviously you have your Class A stuff that's been appreciating heavily. So, we've been seeing that on some of our assets as well. Now, shifting focus, so that was Brett Hatcher's presentation at 9 a.m. And then same on the next one on the investing track was Mike Mealy at 10 a.m.
Was he as positive a outlook as Brett was?
He didn't give really a positive or negative opinion. He was just saying, here's where we are, what we're seeing right now. Mike Mealy's he's been in the industry for like 20-something years. Like the guy's he's just an OG. So when you look at what he was saying, he said, okay, we've been in a weird time over the last 5 to 10 years where money was basically free, so people were paying crazy premiums because they had nowhere to put that cash. We sold one of our CO deals at full price. Literally, they paid us above what we thought we'd sell it for in 5 years at stabilization the day it opened. It was 0% occupancy. And he said that's not typical. In his couple decades he's been working in the industry, typically CO deals will sell for about a 20% premium over cost. And I thought that was a very interesting statistic because, right now I think there's people that think there's blood in the water. Mm-hmm. So we've already seen a lot of people trying to make below cost offers on CO deals. It just doesn't make sense. Obviously those aren't trading. But then he started comparing 2 years ago to this year. The data he had was from mid of 2023. So April-ish, March, April. So pretty new data. So he broke it down into 3 types of categories. You have your stabilized stuff, you have your mid-stage lease-up, so 40 to 60% occupancy, and then you have your CO deals. And then he was showing what was trading based on third-year projections on these types of things. So a stabilized deal, it's already stabilized. Once you buy it, in 3 years, here's what the people are expecting. He deals a lot with larger clients like publicly traded REITs. So they want to see, as far as their underwriting methods, effective gross income will be the input for growth is about 5% by year 3. OpEx growing at about 3%. So 5% EGI growth per year, OpEx growing 3% per year. So still income outpacing expenses. And they're looking for a cap rate at year 3 of 5.5%. So that's not technically a cap rate. What that's technically called is return on cost, because the cap rate they're buying at is substantially lower. But they want to know if they buy today, by year 3, will they be at a 5.5% cap rate on a stabilized asset? And I was like, that's insane.
That is insane because, I mean, when you're looking at, I think we pulled up CMBS debt numbers, and I think the, I want to say 10-year CMBS rate was like 5.7 or 8.
Yeah.
So the fact they're looking at 3 years down the line to be covering a CMBS debt.
And so what he said went into that is the fact that they're going lower leverage, so 60% loan to cost, and they're looking at real rates, not interest rates. So interest, your real rate is your inflation, or your interest rate minus your inflation, and that's your real rate, and that's still negative. So technically you're borrowing and paying the bank back less than what you borrowed because of the loss of purchasing power on the dollar. So right now we're still currently in negative real rates, which means if you're a borrower, you're a winner.
So I get that, but when we look at his other projections and assumptions, where he's saying that effective gross income is going to be increasing by 5% over year, 3% for expenses, we have a 2% delta.
Right.
That doesn't seem like it's correlating with inflation. You could say that the appreciation of the facility is, but to say that it's still a winning situation, it doesn't seem like the numbers all add up to have it be this like, oh, we're able to borrow at these high interest rates and it's going to be so profitable. I mean, it seems like the way to capture that profitability, that delta of we're still borrowing at these winning rates, would only be at the sale of a facility.
No, I mean, so I didn't take down these notes, but I remember just offhand, he was talking about, okay, let's look at unleveraged and leveraged IRR or cash on cash return. And a lot of people are using cash on cash return right now. So even at that type of rate with 60% leverage at that return on cost of 5.5%, typical buyers of this would be a REIT or a top 100 operator. They're still making a 12 to 13% levered IRR and a 10% unlevered. So that's better than stocks, right? That's you got to look at both sides of the picture, right? So what is the return on your equity? And they have so much equity that you also got to think of the opportunity cost of just letting cash sit from investors, and you
just eroded by inflation.
Yeah, eroded by inflation, but you're also most likely paying them some type of preferred return that's accruing, that type of stuff. So at those numbers, and this is what he's saying, this is what is trading right now. This isn't like, this is what should be. This is what he's closing deals at on stabilized deals. Okay.
So 12 to 13% cash on cash return. That was the figure?
Yeah, like 12.7 I think is the example on this one.
See, I mean, that makes sense from a REIT perspective just because their cost of capital is so much lower from their investors.
Right.
But us syndicators, where we're in kind of the mid-market, if you will, the cost of our investors' equity
much more expensive
than 12.7%.
Right. I mean, here's a perfect example. First of all, we would never be buying a stabilized Class A asset. We'd build it, right? So we're already not going to be doing these types of deals. But then you also look at the types of buyers and the types of leverage they're using. I think this still makes sense for them. And then, if we go to where we are, let's start looking at maybe value add or CO type deals. He has numbers on these as well. Things change slightly. So let's go to mid-stage lease up, year 3. So they're projecting a 20% EGI growth per year because obviously you're leasing up. So every year you could expect about 20% of your income, or an increase in about 20%. Their OPEX is still at about 3%. So, this is 40 to 60% occupied. Cap rate or I guess not cap rate, but return on cost on year 3 is 7%. So people buying lease-up plays that may or may not be cash flow positive just yet. So those numbers are looking better. And he said, again, you're seeing people coming in with leverage at 60%. So if I remember correctly, the IRR on this one was slightly higher based on the examples he was using. They were in the mid-teens range. So starting to get into the territory that we usually offer to our investors, right? Mid to low teens or mid to high teens. And then when you go down to CO, this is the one that was very interesting. So obviously at CO, you don't project any adjusted or EGI growth. OPEX at 3%. Cap rate, year 3 of a CO deal, 8%. So return on cost at 8%. So
wow.
Okay, that's interesting. So this is where I think the REITs are, why they're still hungry to buy CO deals, is because they have all this money sitting, and if they could buy it now and just take up that lease-up risk, they have an 8 cap in 3 years.
And what was you gave the middle tier where it's in the middle of lease up, 40 to 60% occupancy, that sort of thing. What was the cap rate that they're looking for? 7 something?
7%.
So that's an interesting difference right there.
1%.
But to get to 40 to 60% occupancy, especially if they're projecting 20% growth in the EGI, I mean, you're looking at maybe 24 months to get to 40 to 60%, right? So
depends on the market. I
guess the question is 2 years of opportunity cost worth it as a syndicator, as the person that actually took the time to build the facility? Is it worth that 1%?
I would say no, because at SSSE our goal is to mitigate downside risk. So if we have the option, now you don't have a crystal ball, you don't know if that offer is going to be there. First of all, mid lease up, you don't know what's going on with the economy. But if you're telling me that I can get rid of all of my lease-up risk, I can not have to tap into any of that interest reserve that I raised capital for, which means I can return money to my investors faster, which means their IRR is much higher.
Yeah.
I would take an 8 cap pro forma all day on a CO deal.
So as the guy in our organization that is talking to our investors, the speedier turnaround time, again, shovel in the ground, we build it, we get CO, and then we're able to exit an 8% pro forma year 3. Mm-hmm. Our IRR is going to be through the roof.
Right.
Our equity multiple is not going to be
no
tremendous. How does the average investor, based on the conversations you've been having recently, feel about IRR versus equity?
Yeah, so I think the more sophisticated investors will typically be running their numbers off of IRR because it's a time-based. It's a cash-on-cash equation that has a net present value equation in the middle of it, or around it, I should say. So it truly, for those listening, what it means is that dollars today are worth more than dollars tomorrow or dollars 5 years from now. Or what I should say is dollars 5 years from now are discounted versus dollars I can get today. So if I can return capital to our investors faster, that means they have a higher velocity of money. They can redeploy that money and start making multiples on it again. So that's kind of the play. So if I were to say, hey, I can triple your money, but it's going to be 40 years, or I can give you 20% return, but it's going to be 3 months, which would you rather take, right? You'd want your money moving faster. I think the newer investors, especially the non-accredited ones, they see the multiples, and that's kind of what they get fixated on, not realizing the value of returning your cash faster so that you can redeploy into maybe another project that has some more significant upside that you can capture before you start having this like Laffer curve leveling of your return, right, versus effort or time. So I thought that was very interesting. He said in general, which is another surprising thing for me here, everyone thinks that we're trading at crazy low cap rates. Everything's going to drop. It's going to jump like 500 basis points, add 5%, and now we're trading at 8 to 10 caps. That's not the case. So he said right now cap rates are up about across the board, average about 100 to 125 basis points. So 1 to 1.25% is where the market is on average over where it was 2 years ago.
Well, it makes me feel good because after my presentation, a lot of people asked me where I saw cap rates at, and I said on the Class A stuff that it had jumped, 0.5. And then I said on the more secondary and tertiary stuff that we were looking at like 1%.
Yeah. So when someone asked him, is this a 2007, 2008 type situation? He said, no, I actually believe that we're in a 2010, 2011 type situation. And so when he explained, he said, I know people during that time that wish they bought more deals. And again, he's a broker, so take it with a grain of salt, but he thinks because of where inflation's going and supply and the amount of people that have dropped off the board, there's going to be a supply crunch like we're seeing in the residential market, right? 2007 to 2009 happened. Basically, everyone left the trades, people stopped building houses, and now we're in a supply shortage that's going to take 5 to 10 years to fix.
So the supply crunch that you're referring to, are you saying it's a supply crunch in terms of the actual renters of self-storage or of inventory for buyers to buy?
Inventory for buyers. I think in 5 years, and I'll talk about what I think is going to happen in the economy in the next couple of years, but I think what he was referencing is that in 3 to 5 years, because all these people shelved their construction projects because either they had very thin margins or they didn't want to give up enough equity to LP investors, they want to keep a larger pie, so they're shelving deals. So all of a sudden in 5 years, when all this product that was supposed to be stabilizing is coming to market, there's going to be nothing, so there's going to be a bunch of buyers for very little amount of Class A assets, which is going to drive up the price. So I thought that was very interesting. So those are the two that I got the most value out of during the seminar tracks, and then the rest of the time I was basically networking in the halls. Is kind of where we get our value nowadays at ISS.
So from those two, I mean, both seemed actually pretty positive, which coming into this with the economic uncertainty that we've been hearing in the news and all of that, we expected that it was probably going to be a little bit of a Chicken Little, skies falling, that sort of thing.
Right.
Because self-storage has performed very well through recessions in the past, but it seems like we're on Black Swan, on Black Swan, on Black Swan, where this isn't a situation that you can point back to and say, oh, well, remember that time that we printed all that money and we came out of the pandemic, but then there was the inflation that we're combating, which actually crippled the economy to a certain extent. Remember that?
Yeah.
Self-storage is great in that.
Right.
So from those two relatively positive outlook, and we're going to once again acknowledge the bias of, brokers kind of have to be positive in their market. What action items did you take from that? What sort of things changed in our strategy as a result of those items?
I think we stay the course. I think the key is to raise capital. We need to have ready capital available and investors that realize the opportunity that's coming on the horizon, especially because our long-term goal is to basically make a 10-figure exit in 10 years, right? So if we can build up a portfolio of 80 to 90 facilities over these next 10 years, either by building them or potentially by buying CO deals that are undervalued at cost or potentially below cost or maybe even 20% above cost, I think that would make sense for us. Obviously, right now we're in a very weird situation where interest rates have risen so fast that sellers have not been able to really stomach it and absorb that. So, I always say that sellers are typically about 12 months in the past in valuation, and buyers are about 12 months in the future in valuation. That's a 2-year divide, but in the last year, rates have doubled. And DSCR requirements have gone up because banks are freaking out because of SVB and SB, going down. So I would like to see more acquisitions. However, I think that's not going to take place for another 6 to 12 months until sellers start realizing that this is not the new mode, but this is how it was before we got all this free money pumped into the economy over the last 10 years. So I'd like to see our portfolio continue to grow, get some acquisitions in there for cash flow.
Yeah.
We've been just through our acquisitions and then also talking to other investors, seller financing is starting to be big again at reasonable rates, basically no due diligence by the seller, lower down payments required. I mean, I just got back term sheets on one of our deals recently, and some of these banks are asking us to put 40 to 45% down, and just because they don't know what's going on.
Yeah.
And we just negotiated a seller finance deal where we put 12.5% down. and better terms in the bank, 3% interest below, what we'd get from a bank or a bridge lender. So that's what I think we need to focus on is, to stay the course, raise the money, continue with our high population growth, high job growth markets like Tampa, Orlando, Charlotte, Atlanta, and then just weather the next couple years. Because if I could pull out my very muddy crystal ball, I think that we're going to see 1, maybe 2 more interest rate hikes of a quarter point. Then they're going to hold it there for like 2 to 3 years. Mm-hmm. And that's going to cause a lot of suffering. And it's not that it's causing suffering. It's just that, we're addicted to easy money now.
It's a byproduct.
Right. So that's going to cause, already I was looking at the Fed meeting minutes this morning, and they're predicting a recession by the end of the year. And as you look at the data, household and corporate debt is at the highest it's ever been. Household savings rates at the lowest it's ever been. Like, there's nothing that can budge. So people are going to start really feeling the pain. And then I believe that due to either political pressure or, other pressures, I think the Fed is going to be forced to start cutting rates again in the next, as soon as 3 years from now. So if we can make it through the next 3 years without slowing down the amount of product that we're going to be bringing to the market, we can come out on the other side and refinance at great prices, right?
Because our terms are usually 5 years
or more.
Minimum,
yeah,
if not longer. So that was something interesting, just taking some looks into the research on recessions. The average recession lasts less than 4 years, which feels pretty good when the average commercial loan that we're getting is at 5 years.
Yeah.
An article that I saw this week was that the International Monetary Fund came out with a statement thinking that they are going to see back to zero interest rates sooner than 3 years.
I mean, that would help us, especially if we can accumulate product right now. What do they say? Date the rate and marry the asset or something like that?
I do not know that one.
Because the rates will change, right? I don't think that is sustainable in the long term, like of our economy or the world economy, because everyone is levered up. So I think there's going to be a great restructuring that happens like across the world. There's just so much derivative products out there on a very small base of money. However, you got to play the cycles. So it's tougher right now. It's by no means like the 80s or the age of Paul Volcker where, you had 18% interest rates. But if it goes back to zero, okay, we have a couple loans that are in the, 7 to 8% range right now. And then if we're at a zero interest rate again, based on a spread, we might be able to see commercial loans again in the 4s and 5s and just refinance. But that time, our assets will be stabilized, or the beginning parts of our portfolio will be stabilized, which means that we can roll them into non-recourse long-term debt. Potentially, CMBS has a 10-year balloon, or we can go life insurance companies that do some of these full AM products, 25-year fully amped, 30-year fully amped, 40-year fully amped, at lower leverage, and just lock in that low rate until the rates start rising again.
When you look at what the average cap rate has been for commercial real estate since the 80s, it has never averaged higher than a 9% cap rate.
That's crazy.
With your research and understanding, do you think that is because just leverage drops when it becomes an 18% interest rate environment, or do you think the creative outskirts of financing is what allows for it to stay within that pocket of sub 9%?
I think it's both. So you have, buyers and sellers getting creative, especially the sellers that have either assumable mortgages or are low leverage and willing to take a down payment that pays off the rest of the loan and then carry the rest of it so that they can make some, interest income. But I also see leverage dropping because now it's not even a factor of debt yield. It's more of a factor of, does the thing debt service at a 1.3, or I even heard people talking about term sheets that are getting at 1.4 DSCR. So like that severely restricts how much debt you can throw onto the asset. Like I said, banks, we are getting terms from banks on construction loans where they want us to put 45% down. Obviously, those are the banks that don't know much about storage, so I'm going to be sending them Brett Hatcher's presentation. But it's, we used to get 80% financing from banks. I think those years are long gone. I think we're going to be high 60s, low 70s leverage going forward on construction stuff. Or I think a good strategy for us is to leverage as much as we can with the SBA, which offers, 85% leverage up to 90% leverage. But instead of maybe doing the whole project at once, we phase things in to make it safer for our investors and also give the ability for the bank to feel like they're in a safer position, because now they can give us an expansion loan. There's an underlying asset that's already cash flowing. We get to break even debt service, or break even cash after debt service, much faster. So one of the feedback that I've gotten recently from banks is that they want to see us cash after debt service positive within 24 months of operation. And when I asked, is that because you're putting 12 months in there for construction, so if you finish construction faster, we get faster, we get a longer period? They said no. Doesn't matter if construction is 3 months or if it's 12 months or 15 months. Once you get CO, we want to see that you're cash after debt service positive within 24 months of operation. So I think now the play is get larger pieces of land, build Class A single story that we can phase in over 1, 2, or 3 phases.
So what you're telling me is that when Oxford Dictionary comes out with their word of the year, it's going to be downside mitigation just conjugated into one word. With the 24 months to break even or cash flowing, how are they structuring that in terms of like the actual loan? Because as you said, it can take 3 months to be able to get to shovel ready, or it can take 12 months, depending on entitlements and all those sorts of things. And we've certainly experienced with our Midwest roots, if the ground freezes, we're not pouring concrete.
Right. I mean, I think it depends on what type of loan product you're getting. The banks, that's just going to be a loan covenant that you have to be at 1.0 DSCR.
Triggered by CO.
Yeah. After 24 months, right? CO, and then you get 24 months. I think that's going to be a covenant where if you don't hit that covenant, then they have the ability to call the loan due, or you need to go renegotiate, what have you. But as far as the product goes, I still think banks are doing these 5-year balloons on, 25-year AM or 20-year AM. I'm starting to see a lot of banks offering. Or if it's CMBS, 10-year balloon on 30-year AM. If it's SBA, you're looking at 25-year fully AM deals, or maybe they're variable rate, but you get full 25 years of term. So I think it's interesting. The problem with SBA is they don't like syndications, so you can't really have limited partners. You have to bring everybody in as a general partner. You can only have a couple partners.
Yeah.
So what they mention is if you don't want them underwritten, technically the rule is 20%, but to be safe, you don't bring anybody in that's more than 18%. They don't have to be underwritten.
So let me put a pin in that. So we were at a breakfast today with JLL, and they were talking about a structure of bringing in what would normally be LPs, but onto the GP side for a participation model with more institutional investors. Right. So that it becomes kind of a 20-80 where you take what would normally be your LPs, put them on the GP side, so you're able to contribute with your institutional partner in the invest. Would that sort of structure work with SBA and do a better job than I just did of summarizing what the suggestion by JLL was?
So we were talking about equity and raising equity and partnering with more institutional-based limited partners. And so what they saw a lot of was what's called a GP fund. So typically when you deal with institutional partners, there's a co-invest criteria. So if it's a $5 million, equity raise, they're going to do a 90-10, which means you need to bring 10% of that $5 million raise, right? So you yourself, net of fees, have to leave $500,000 in the deal. And now obviously that's a very large split, so the LP is going to get a much higher percentage of ownership. So what they're seeing is, instead of you getting your, just working with your institutional guys, what you do is you create a GP fund with your retail investors. They come in, they're LPs in the GP fund, but the GP fund is the GP with the institutional. So that this method won't work with SBA, because the way SBA looks at ownership, they drill down to the individual owner's level. So it still would not work with SBA, but it could potentially work with a bank or, more middle market style of, type of debt.
So the GP fund, it would still have to have the retail investors being owners of an LLC, almost in more of a JV structure than trying to do a syndication within a larger scheme.
The biggest thing that was expressed to me was like, you can't really have more than, call it like 5-6 partners on a deal.
And not scientific. It's just,
right. Yeah,
they want to keep it low.
It's up to them, really. It's, it's a lot of gray area stuff. So you bring them in, they're all 18% owners or less. There's like a couple of them, 5 or 6, including you. So the problem with that is that means that the minimums are much higher, right? If we do something like that, that means like if you want to come into our deals, that's a $400,000 or $500,000 check, as opposed to saying a $50,000 or $100,000 check, because we have to keep the amount down for the raise. But we don't have to raise as much because the SBA allows for 85% leverage. There's a 50% first position that is from the bank, and then a 35% second position from the SBA itself. Now, this is a 504 loan. The SBA 7A loans are a little bit different. There isn't like a debenture model that is used.
The handicap of the 24 months to break even, though, makes it very difficult to be using the SBA for these ground-up developments unless we truly are doing just the phased-in stuff, especially single-story, just because otherwise it's going to be too big of a price point to be getting to break even within 24 months.
So, I mean, one of the variables here is lease-up velocity, right? So, when we're super conservative, we're always saying that it's going to take 2.5% lease up per month on an institutional grade asset. So that's a 40-month lease up, right? So you have 3.3 years plus a year for construction. So you're at almost 4.5 years. So that's not going to work. However, if we are able to go into a market that's, say, like Tampa Orlando corridor, where the lease ups are insane, we're just talking to our buddy Andrew Abernathy from Abernathy Holdings, and he's doing some stuff in downtown Phoenix where he's getting 15% a month lease ups. Yeah. So at 15%, that's 7 months that you're filled. And we're hearing that in some of these crazy markets like Florida, like Phoenix, Las Vegas, where people are coming in and they're getting full lease ups in 12 to 15 months.
That's a diminishing effect, though.
Right. So it just depends. We always rely on our third-party experts, so not only the feasibility studies, but also the property management companies that we use. I think you spoke with Dave earlier today from Storage Asset Management. They have really good data across all of their stores. They're the third largest property management company in the world, really, in the United States, which is also the world.
Number one
privately owned. So they do projections for us, and there's always, for example, our Kings Mountain one. I said, Dave, I love it. Like, where's the data coming from? I talked to his data guy, and I said, I would like this to be a little bit more conservative, just for me to feel comfortable, just because I'm an engineer. So we're actually getting some of the projections back on our Florida properties coming up pretty soon, and I'm assuming the lease-up velocities are going to be insane. I mean, some of the markets we're going in, population growth is 10%. Like, that's insane.
Yeah.
So that's the thing. I think we need to focus on high growth markets, and if we're not able to get to where we need to get to on break even, based off of it being too large of a size, even taking into consideration the higher lease-up velocities, then we'll have to go into a two-phase approach where we can get the first phase up and running and cash flowing, and then hit it for a second. And the SBA, the way they do it, is interesting. It's not really a refinance. They kind of adjust your loan, but there's tons of ways you can do this when you negotiate with banks. A bank could put like a B note, or they can take a second behind their own first, that maybe the amortization is slightly changed so that it lines up exactly with the first note. So I think there's a lot of ways. I think as long as we stay the course, a lot of people got into this industry that had no business being in this industry, and they were rewarded for making mistakes over the last 5 years, and that's just not going to happen anymore. That's just going to be, it's going to wipe out a lot of competition, and only the people that have truly sound business models and operations are going to be able to outlast this next 3 to 5 year storm.
Well, I think that's a great place to end it. Just let people know that they need to be stepping up to the plate and swinging for the fences.
That's right.
Well, thanks for listening, everybody. This has been Stephen Ware and Fernando Angelucci from SSSE.